Pleasure to be here. I think this is my 12th AAII presentation, I think, over several years. My hometown, Rochester, New York, was the first a number of years ago. Mr. Jones here. I have great esteem for him. He is from Syracuse. I am from Rochester. They're very... Buffalo! Oh, Buffalo. That's 3 in a row. The snow hits Buffalo, then it hits Rochester, then it hits Syracuse. And so we're all very glad to be from there, I think. I had a really fun time this morning driving here. I'm staying with 2 very good friends, Heather and Michael, and they have a 10-year-old, actually a 10-year-old and a 12-year-old. And the 10-year-old was very interested in what I do, and he asked me if there was any hot stock I would recommend. He's 10 years old, okay? 10 years old. And of course, what did I tell him? I said, you buy Berkshire Hathaway and you never sell it. You just never sell it. Because I'm afraid once the actuarial tables get to Warren, I bet there'll be spin-offs. And that will be one of my topics today. Of course, he didn't want to hear about that. He wanted to hear about the Uber IPO and all this stuff. But it reminded me when I was 10, 11, 12, I had 3 ambitions. I wanted to be an English teacher, a lawyer, or a writer. I wanted to be those 3 things. And I have done all 3. But I didn't ever mention stock investing because I assumed that. My father and I bought 2 shares of Ford together in 1968. And it never occurred to me I wouldn't be investing. It just didn't occur to me that I'd be able to invest for a living. And that, a lot of people, you get these hedge fund guys who'll say, I would do this even if I weren't making my living doing this. I don't know about that. I would be having a blast with stocks in the same way that AAII members are DIY investors and committed to education. I listen when I'm introduced at these various presentations. People will talk about, better have the pointer thing, or I'm going to get back there and not be able to switch my slides. And every group has some interesting special interest group, and they're meeting and talking, and reminds me of my first AAII contact, 40 years ago or something, but it might have even been longer. So, both presentations have their feet on the ground in the dividend income world. Even though the second one is special situations, who's Maurice Schiller, what does that all mean? They're both grounded in the 2 things that I've learned to do for clients. I had ideas about what clients really need, what they should need, because I know everything. Well, there's nothing that you get disabused of faster than working with real people than to discover that you do not know everything. And actually, people have a pretty good idea what they need and want, particularly in these groups. I'm not saying I don't have any educational difficulties. That's where I put my high school teaching to work. I couldn't get, I would get these people who would say October, November, I'm worried, I want to go all to cash and all this stuff. I said, you can do that, but not with me, right? I do not market time. The reason that we do the things we do is so that we don't have to decide what's going to happen. So some of them, 2 in particular, they wanted me to liquidate everything and go to cash, and I said, that's fine, but you can take your money elsewhere. I don't do that. So they were really happy in December. They thought they were just ultra smart. They had called the market, right? They still have not reinvested, so they're doing the typical thing, which is to sell low and buy high, right? If you look at the S&P, which is not what I invest for, but when these particular people wanted me to liquidate and go to cash, the S&P was at a level lower than today. Now, nobody knew it would snap back. Who knows? Nobody knows what's going to happen. I know only that history shows, and I lived through 73, 74. Everybody talks about 2000, 2002, 2008. Some of us remember 73, 74. That was a cry for your mama, right? And that was when Warren Buffett called himself, these are his words, he said, "I felt like a randy man in a whorehouse." They wouldn't let me put that in an article at the Motley Fool. And I said, that's what he said. Those are his words. And he followed it with everything was on offer. So he was buying hand over fist. And Berkshire did 32 times in the next 8 years. Right? So you just never, you just hold on. Oh, Tom, I'm like, 50, 60, 70. I can't hold on. I'm like, well, let's talk about your investment strategy. So I don't know quite what the point of that was. Yes, a lot of my education job is just to get people to not panic. Because what's the biggest mistake individual investors can make? Buy high, sell low. And if you do dividend investing or income investing, whether you're harvesting it for retirement or whether you're compounding over time, you just don't have to worry about this stuff within reason. And I'll, of course, get to some of the exceptions. Now, I'd like to say, so this morning is you're primarily interested in current income. And this afternoon we'll be using dividends and other, getting paid while you wait for other catalysts to drive stock prices higher. And getting paid, of course, one way is with dividends. What is the thing that's always said about dividends? That 50% of the return of the S&P 500 is due to dividends over time? Yeah, I mean, sure, double taxation, whatever. But I like to get cash in hand. I prefer a bird in hand rather than two speculative birds in the bush. But it's like anything else. You can't just pick dividend stocks. You have to actually look at them individually. And dividend aristocrats, which I'll get into, are always overpriced. So you take a bigger risk of the stock falling than your 1 or 2% that you might get from Johnson & Johnson. On the other hand, if you're buying Johnson & Johnson and holding it for 30 years, like I was telling my friend's son in the car with Berkshire Hathaway, I mean, as we know, time is your friend. He's 10. It's just that he'll spend it on, he'll spend it on video games and probably college, we hope. But I tried to plant a seed. All right. I call this Huckleberry Harvest just so I have a fancy name or clever name to tell clients to sort of give them the idea of what we're doing. If you're primarily harvesting the income, you can do this younger and then compound with dividend reinvestment. But people say 6, 7, 8%. Tom, this must be a scam, or you must be selling. And actually not. This is not an original thing with me, and most of you can guess that. But it's the advantage the individual investor has. All of us have an advantage with any money we're not using, that we're not having Wells Fargo invest for us, or Merrill Lynch, God help us, Morgan Stanley. Great companies, certainly actually some of them great investments over time, but they have an inherent problem that we don't. Small is beautiful. Size is the enemy of returns. A major point that I will be repeating ad nauseum. The retirement problem. I think it's important to restate the obvious as many times as possible. When I was a high school teacher, students with whom I'm in touch thanks to Facebook, apparently I don't have any privacy concerns, they would say to me, "Remember, Mr. Jacobs, we used to say," I'm like, "Please, Mr. Jacobs, you're only 8 years younger than me now, you're old." And they would say, "Mr. Jacobs, we get it. We get it," in only that way that a teenager can do, right? And so you will probably be saying that by the end, but what I'm hoping is that it will stick. What is enough? What will it earn? How long will it last? And where will it come from? It's really the only questions we have. It's just that they're, of course, impossible to know because we don't know when we will die. And what was as Charlie Munger says, tell me where I'm going to die so I don't go there. And that goes back to a Greek tragedy, I forget which one. And what I'm getting at, of course, is that we accept too little. We don't have to take excess risk, in fact, not at all, to increase our income. Now, a lot of you are familiar with the 4% rule, which is William Bengen, who was an aeronautical engineer from MIT, had this wonderful technical career and decided he was going to help people in the financial world. And as an advisor, as a planner, he kept getting these questions all the time, which was, well, how long will my money last? And we have no idea. We have no clue. How do I know if I have enough? What will it earn? Those same 4 questions. So he did a ton of research and found that there was no 50-year period between 1926 and 1976, rolling, where a 4% withdrawal rate in a 50-50 mix of stocks and bonds exhausted the money in under or fewer than 33 years. So this became a rule of thumb for the 4% withdrawal rate. And this works for the average person who has about as much interest in learning all about money as eating cardboard. I mean, most of my clients, I will say to them, okay, why aren't you at Vanguard? I'm happy to show you to the Vanguard site, help you fill out the forms. What is it about me you want to pay 1% for? Which, by the way, as a lot of you know, is cheap. But I don't wire money for them. I don't do their answer tax questions. I figure they can go to Merrill Lynch and pay 1.5% and 2% for nothing. They don't need to pay me that. All right, 4%. Well, who can live on 4%? You have $1 million. You've got Social Security. You rolled over your 401k. I'm sure a lot of people in here have well more than $1 million from their 401k. I don't know how many of us still have traditional pensions, but I'm talking about just your investable assets. So 4% a year. That's not much money, but you can get a raise. And I don't think that we break the Bengen rule, but what he's doing is he's doing it for the average person, trying to find something so people don't have to worry about it. But we're in a low-yield world. You certainly didn't need me to come here to tell you we're in a low-yield world. 2-year CDs are paying 2.8. Is that even accurate? I'm not quite sure about that. Treasuries, 2 years are 2.9, 10 years 3.2. S&P 500 is yielding 1.9. Inflation is 2.3, so you're not doing all that great versus inflation here, folks. So we have $1 million invested in these allegedly safe instruments yielding $19,000 to $32,000. I am certainly not planning on living on that, plus Social Security, even if the mortgage is paid, and I don't think anyone in here is. So now Bengen in a lower yield world has decided that you need to actually take out more and perhaps accept less time. And now what he says is you start with X% depending on your years, and you increase it, the dollar amount, by inflation thereafter. Okay, this is just too, I want more. So what do? Well, most people these days are realizing they're going to have to work longer. And a lot of us are perfectly happy to work. We just don't want to work at things we don't like just to make the money. But I doubt that most people I know, most of my friends who are around retirement age, I'm not, they expect to do something, but they just don't want to have to work the same kind of hours for a lot of money at things that maybe they wouldn't choose to do. Or we spend less. Well, we're probably pretty good budgeters in the first place if we saved in our 401k or we built a business and sold it, that kind of thing. So how much less can we spend? Or we earn a higher return. Well, most people think that to earn a higher return means you have to take more risk. So for example, what happened with the low yield world? The low yield world generally boosted the stock market through the roof as people search for yield in terms of capital gains. How's that working out? Well, we did have December. Now we have January. We had 2008, but yields were not decreasing then, right? It's post-2008. So how do we get a higher return? Well, of course, I'm here with a solution. Otherwise, what would I be? You know, I've got to have all the answers. All right, so 6, 7, 8% yields, never sell shares. That is, you don't withdraw your principal. If you double your income from 4% to 8%, a lot of people in here probably can stop withdrawing from the principal. Right mix of stocks and bonds. Now, when we're building our fortune through a 401k plan and our employers are matching, or can I ask this? Yeah, it's not personal. How many people, the majority of their assets today are in assets that were built in a 401k or then rolled over in retirement? How many? Okay, phew, all right. I'm not assuming a lot of stuff that's not true. That's always good. So when you're building it, you're doing what? You're dollar cost averaging. You're adding every paycheck, your employer is matching, you're buying more stock in some index fund that your company offers when the prices are low, and you're buying fewer shares when prices are high, so you're averaging out. Everyone in here is familiar with dollar cost averaging. What I find people don't get is that if we follow the 4% rule, when our portfolios are not yielding 4%, we are reverse dollar cost averaging. We are selling more shares at low points to meet the withdrawal and fewer shares, have I got this right? Yeah, at high point. We're reverse, thank you. I see a few nods of people who actually, they can work their math better than I do. So we're reverse dollar cost averaging. Now, if we can do that, if we can have a no withdrawal and only harvest the income, well, it's obvious. Then we're doing better. And we can get a raise every year, which I will get into. You're not stuck with the yield you have at the start. So let's just take $1 million, which I guess $1 million doesn't buy what it used to, but it can produce $77,000 a year for us at current yields of the mix that I'm going to talk about. And I would guess that this is probably more than most of you are earning on if you are in a situation where you're living off the income from your investments. Oh, you're so cute, a little elephant. This is illustrating the principle that the smaller investor can fit in the bathtub and has more options than, of course, the parental investor, the elephant, who can't fit in the bathtub. And I will explain a little bit. Any followers of William O'Neill and his technical analysis approach are well familiar with the point of the elephant in the bathtub. And the point being that there's obviously more liquidity. No, there's a limit on liquidity. If you consider the water in the tub as average daily volume for any number of stocks, the big elephant cannot play in that tub. There's not enough liquidity for that elephant to play, whereas the little elephant, which is us, and I'm getting bigger and bigger in the elephant department every year, has more options. Now, what do I mean by that? For some of you, this is a concept you're well familiar with. For those of you who aren't, let me take a little time. These are some real estate investment trusts. Remember I said that I'll be talking about a mix of real estate investment trusts and closed-end bond funds. So Ladder Capital, which is a REIT, it's commercial landlord and also makes mortgage loans. Its market cap is $1.9 billion, or 1/350th of Apple, I guess. And its daily dollar volume is $11 million. BlackRock Floating Rate Income Fund, $1.6 million daily volume. Medical Properties Trust, $24 million. Nuveen AMT Free Municipal Bond Fund, AMT being alternative minimum tax free, $5 million. Okay, now you're Wells Fargo. I walk into your office. You manage $1.6 trillion, cue Dr. Evil, of money worldwide. You cannot offer a portfolio of these companies. You're offering, and believe me, you're offering the same thing worldwide. If any of you have walked into a Bank of America or Morgan Stanley, whatever, and they'll hand you these lovely portfolios, right? Income, international, balance, and they're all wonderful, and they'll be great for people. I am not, There's a reason they're in business. If they weren't helping people over the long run, even with the ridiculous fees, people wouldn't be investing their money with them. But there's a funny thing that happened. A friend of mine asked me to look at his. And I looked at them, and I noticed that 20, 30 stocks in each one of these models, balanced, international, equity growth. And I noticed that 5 or 10 stocks appeared in absolutely all of them. And you will find this at any of these big firms. So you've got Bank of America is balanced and international and all these things and growth and income. And how is that? It's because they can only, when you're dealing with $1.6 trillion in assets, you can only invest people in the same 30 stocks. Well, we don't have to do that. And you might think 1.6 million is not a lot of daily dollar volume. Let's say I have 20, 25 stocks in my clients' portfolios. You divide it, and we do not have billions under management. We're relatively new, the firm that I joined. I'm the Eminos Grease without the Eminos, and they're half my age anyway. So we can easily invest clients in these, and we can easily sell if necessary. This is enough volume for the individual investor. Add it out over a number of days, and you get more than enough liquidity. It's a big enough bathtub for the little elephant. So that's principle number 1, or 0, I forget my numbering system, which is small is beautiful. Some of us remember from the 60s. Small is beautiful. Point 2, we get a raise every year. So let's say we pick a mix of stocks and bonds, REITs, real estate investment trusts. Real estate investment trusts are not in business to have a flat dividend. They're in business to get more real estate assets, collect more rent checks, and pay more out to us. So, let's see here. Okay, this is just so fancy. I love this spotlight. Okay, you got to have some fun, when you're presenting, right? I don't even know what I was doing that for. It was probably just for self-entertainment. So if the stock price is flat and the dividend, which is on this side, is rising, and I'm only talking 5% a year. A REIT that doesn't raise its dividend 5% a year, you don't want to own it, and probably nobody else will either. So that's this line. Stock price is flat, and the yield on this flat stock price, pretty easy math, will increase. So principle number 2, you get a raise. If you pick them right, not on the bond side. Right? The bond side is going to be fixed income generally. Your REIT side, you're going to get a raise. So you get a raise. This is the joy of, so people think, well, Tom, okay, 8%, 7%, even 6%. This is much better than I'm doing. But what about inflation? And what about, we're getting a portfolio raise. Now, it's not 5% a year across the portfolio, but maybe like 2%, because the bond side will not be raising rates. There'll be inflation-adjusted increases and decreases, but it won't be real increases probably over time. So we get a raise. Now here's a really cool thing. You probably know that for any time you make a point, you have to give the most exciting, most wonderful example and act like this is what we're all going to get. Well, I won't act like this is what we're all going to get, but it is pretty exciting. So you're Warren Buffett and you're buying Coke when it tanks in the late 80s. His original shares, the dividend on the original stock, was 39% a year when this chart was done. And a few years later, it's 64% a year. Now, I wouldn't buy Coke today for a lot of reasons. Market tanks, Coke will be cheap. But this is the principle. Now you might say, well, Tom, I don't have 30 years or something like that. You don't have to have 30 years. This is just an extreme and wonderful example, in my opinion. Pretty clear to everybody? Dividend back in '88 is about here. Dividend in 2013 is $2 or something. I can't read, I'm too close. And then more today. On those original shares, it's 64% a year. Now, of course, inflation and so on. But you're getting a raise every year on the initial investment. You don't just need and meanwhile, of course, we all know what Coke has done through this period. And if you're reinvesting, all the better. So, number 3 is that flat stock price, you get a raise if the dividend is being raised. Your yield increases on your initial stock price. Now, if the dividends rise, the stock price doesn't actually sit there. It rises. And here we have the magnet of the dividend. Now, this can take a long time to work. Stocks do not follow dividends day to day or annually if they're raised. But over time, it's an inexorable relationship, the correlation. Dividends up, stock price up. So here we have our friendly chart again, which given my PowerPoint skills, I was polishing last night at 11:30. Like, why can't get the colors to work? Now, if I just paid somebody on Upwork, you guys use Upwork at all? I use a lot of Upwork contractors. I probably could get this spiffed up, but I'm a bit of a control freak when it comes to my own presentations. So here we have the yield is flat. Before we had the stock price flat. Here we have the yield flat. The dividend rises, the stock price rises. Why? Because if somebody is willing to accept, let's say, a 5% yield on a stock, and the dividend rises, if the stock price is static, the dividend yield is rising. And as it rises, people will buy the stock. If they're willing to pay for a 5% yield today, well, people will want a 5% yield on this similarly attractive business somewhere down the road. Now, in a portfolio that's 50-50 stocks and bonds chosen this way, we're not going to get a whole lot of this because our dividends are rising on a portfolio basis a couple percent a year, but we'll be getting a couple points of stock price appreciation. Well, you don't need a whole lot. If you're making 6, 7, 8%, you don't need a whole lot of points here on top of that, right, to have some nice little annualized return. And so it's not just no withdrawal of your principal, but your principal over time will increase. And point number 4, the rubber duck rule. The rubber duck in the tub. Now, I used to carry around a cylinder, a big sort of vase of water and the rubber duck. And the problem that would happen is I would forget what the water represented and what the duck represented. So this way, I don't look like a complete idiot if I'm sort of stumbling around. It's very funny when I've got the duck here and I'm like, okay, so the water level is the stock price. And yeah, so we're spared the rubber duck rule. The rubber duck example, not the rule. We have to learn the rule. All right. In this case, we get downside protection, which is always nice. A lot of us, if we're in more of a dividend income situation, we don't want a whole lot of volatility. If you're 20, 30, 40, 50, even 60, you can ride out volatility. It gets tougher when you're 70, 80, 90, or so I'm told. So the stock price drops. Your dividend is static. What happens to the yield? The yield rises. And so it's sort of an automatic stabilizer. The more the stock price drops, provided the dividend is not reduced, the yield rises and people run after it. We all know this. Yield pigs, right? There are people who just want yield and they will chase yield. And sooner or later, the stock price will normalize. And this is over enough time so that inflation gets to be worked out in dividend hikes and so on. So, if you have a stable cash flowing company and the market tanks, like in December, all of a sudden you get these crazy yields. Now, I don't worry about that because I have a lot of closed-end bond funds that are throwing off cash every month. So in December, that all gets reinvested. I don't care. And my clients don't have to worry whether they should liquidate and go to cash or not. This is not anything original with me. All of you know this. So with dividend or fixed income, if you're not taking everything out and you're reinvesting, you get a little dollar cost averaging. when things happen. And things don't just usually tank for a month. Typically, drops are nasty, brutish, and short, but they're not that short, as they have shown to be so far, but who knows what will happen. All right, rubber duck. You push down, it gets harder and harder to keep it below the water. As the price drops and the duck goes down, the pressure from the higher yield pops the duck back up, and there you are. Is that as clever as I thought? Thank you. Very good. Very good. Humor the presenter. I like that rule. All right. So what we have with harvest is, my goal in this is a 9 to 10% a year combination of income and capital appreciation over time. And I'm sure that, in retirement, or if you have a long-term perspective and discipline, looks good for people. Current yield's about 7.7, and it comes from dividend raises, which I've discussed a little bit, and a climb towards net asset value, which we will look at in depth. So, the method is a 50-50 mix of stocks and bonds, and that's what Bengen said. We want a 50-50 mix. Now, a lot of you are probably familiar with target date funds. Target date funds say, okay, when are you going to want your money? We will manage your mix of stocks and bonds for you in this fund. Now, in ye olden days, that mix was based on our age 100 minus our age is the percentage of, God, this is why I really need a script. Stock. So 100 minus your age, you're 80, you have 20% in stocks, 80% in bonds. That sounds like a lot, but the idea is it means a lot of bonds generally, the older you get. Is that right? Yes. I think Christine is on my side here. Yes, or vice versa. Right. We live so long now, that's kind of not a good idea. Do you know Dimensional Fund Advisors, founded by Nobelist Eugene Fama? They're actually, for a company that does individual management, has mutual funds and so on, they're really one of the best. And they've reimagined this glide path. It's called the glide path because your stocks glide at a certain percentage, your bonds glide. Target date funds, they'll manage this for you. Target date funds have the same problem that Wells Fargo has, that they manage so many assets that they're restricted to bonds and stocks that pay very low yields. And we live so long, we really need, we can't go to 10% of stocks when we're 90. We might live another 10 years. Friend's mother is 101 and sharp as a tack. Well, pretty rare. I think we all hope for that. But you just never, we live a long time. Inflation takes a bigger bite. So they came up with this idea that actually the biggest danger to your money is 5 years basically before you're going to retire. How many of us knew people who were planning to retire in 1999 because they thought the level of the stock market was going to remain at a permanently high plateau, as Irving Fisher said in the summer of 1929. So Irving Fisher, by the way, who invented the Rolodex. So even though he's famed, does anyone even remember what a Rolodex is? He was famed for that remark that stocks were at a permanently high plateau, and of course they weren't, as my grandmother soon found out to her detriment. And he became rich from the Rolodex, so it really didn't matter what his advice was. I guess the point is to have a very successful business, and then you don't have to care about the market so much, especially when you're wrong. So 50-50, we do what Mangan said, have a 50-50 mix of stocks and bonds. Everything okay? Volume okay? Okay, nobody's gotten up yet. Feel free. I'm the one that gets to move around, This isn't, stretch your legs. If any of you have those features like I have on my watch where it tells me I have to stand up at least once an hour, yeah, I just turn the watch off. Okay, so we want to diversify though. We don't just want one kind of bonds and we don't want one kind of REIT. What if urban, commercial, AAA, or whatever it is, real estate has a bad 10 years or something? We want diversification. So I play primarily in 3 categories of stocks that are all REITs: commercial landlords, infrastructure REITs, and recession-proof REITs, which is, it's like recession. Well, who wouldn't want that? But there are areas where you can pretty much say, particularly in healthcare, given the demographics, I'll look at medical properties trust, you can say we're not going to have a whole lot of problems in a recession with the fact that there is a shortage of skilled nursing facilities and there is an increasing demand for those beds. 3 categories of bonds: the floating rate, which has been very helpful in a rising interest rate environment. We seem to have had a pause on that. That was mentioned by somebody in an introduction. I don't really want to be playing where I have to guess Fed rates. And so what I like to do is pick things that in the past have performed very well during both rising and falling interest rate environments. And they exist. Believe me, you know this. If any of us could predict Fed policy, we would be, I don't know, drinking umbrella drinks in St. Bart's or something, if that's what you're into. But we wouldn't necessarily be here. We would make a wonderful living predicting the direction of federal funds rate. What is a REIT? It's just a way to own real estate for real people like you and me. On a good day, I'm real. So the REIT owns real estate, collects the checks, pay them to us, gets favorable federal taxation if they pay a certain amount to us. Very simple, wonderful device. No double taxation of dividends, all kinds of REITs, which have expanded. So for example, not too many. Recently, infrastructure became approved as a kind of real estate investment trust. So pipelines, you don't just have to own MLPs to have pipelines. Toll roads, all these kinds of things can be owned by REITs, and the income can be passed on to us. And we just love that. We love getting tolls on toll roads paid to us, particularly where they're restricted. Like there's this major toll road that goes through Sydney, and it's all there is. And Asia's Warren Buffett, Li Ka-shing, I love to refer to him as Li Ka-ching. He owns, actually he's retired, his son runs it now, Chung Kong Holdings, massively successful Berkshire-like company based in Hong Kong, and he owns, one of his companies owns this toll road in Sydney. I mean, it's just, you just keep collecting the tolls. It's not quite as good as a pipeline because there is some maintenance, right? But pretty darn good. Pipelines, like no maintenance. Well, no, and it's funny. I come from an area where there's a big Marfa, Texas, population 2,000, major pipeline issue. Equity transfer partners, energy transfer partners put in a pipeline. I'm not going to get into the politics of this. I'd be run out of town if it ever got back to Marfa, whether I was pro or con. But that was a huge issue. What if there is there an explosion, Anyway, in general, pipelines are good to own. There's a great story about Benjamin Graham, Buffett's teacher, and John D. Rockefeller. So let's just take a little break for a pipeline story, shall we? So, all right, this is in the day when you don't have activist investors. It's unseemly in the white shoe world of Wall Street. We don't do that. We all just sort of, we men, right? White old men, of which I am increasingly one, get together and sort of decide what's going to happen on Wall Street. So Northern Pipeline Company, they own pipelines. They have all this cash sitting there. It's sort of like, well, what do you need it for? I mean, how much maintenance do you do on pipelines? Not much. Explosions, we'll put those aside. So Benjamin Graham, who is now, it's in the 1930s, he got killed in the crash, and he's clawing his way back doing what he became famous for, which is deep value investing. Making sure that you buy hard assets in markets that sell them off, so you're buying them at a discount to their true value. It's familiar to everyone, the value investing. So And in the 30s, he makes it all back and more, establishes his reputation, founds the modern school of value investing. So he finds Northern Pipeline, and his investment fund buys a slug. Well, you don't do this back then. But he decides he's going to have a proxy fight to get some control, to get these folks to dividend out all this cash that's sitting there. And he doesn't get too many people interested. So it's like, Sonny, just let the wise people run the company, and you just leave it to us, right? Which was predominantly the attitude at most companies until the activist became more active in recent years, recent decades. So Benjamin Graham is a clever guy. He finds out where the largest shareholder has lunch almost every day. The largest shareholder happens to be John D. Rockefeller. So Graham goes to lunch at this place, probably spending more than he can afford at his age and situation. And one day, he pulls it together, gets all his moxie, goes over to the table, says, Mr. Rockefeller, I am Benjamin Graham. I'm a shareholder in Northern Pipeline. This is what I believe. Will you vote your shares with me? And Rockefeller thinks about it and says, no, I will not, but I will not vote them against you, which is pretty good, right? Abstaining. And so the first successful, well-known activist situation occurs. Graham's position is adopted, the money is dividended out, and he makes a lot of money for his investors. I'm not quite sure what the point of that was. I think it was just interesting story time, but it's also, I think, pretty cool. And then about 10 years later, Buffett takes his course at Columbia, gets the only A+ that Graham has ever given. Buffett goes to work for Graham, then moves back to Omaha, opens the Buffett Partnership, and the rest is history. REITs, back to them. It was kind of a pipeline thing, right? Yeah, infrastructure REITs. Good, there's a relationship there somewhere, however tenuous. So this was a shock to me. REITs in general, so you wonder about the good ones since they will outperform. REITs in general has been the best performing asset class in the stock market since the 1960s. At 11 to 12 annualized total return versus 8 to 9% for the S&P 500. I found that very interesting. You didn't have to get fancy. All right, let's look at our categories of REITs and bond funds and how we get this mix and how we get this high yield with a little teeny bit of capital appreciation, magnet pulling the stock price on the REIT side of the portfolio. Commercial landlords. I'll just do one or two examples of each to make the points and also give you a few. These are not recommendations. I mean, I have to say that, and it's true. When I manage a portfolio, all the pieces are related to each other. It's like economics and Buddhism. Everything is connected, right? Okay. Average yield on the commercial landlords right now in the portfolio is about 8%. Ladder Capital, wonderfully run commercial landlord and mortgage lender. Current yield's 8.2%. Dividend is growing at 5% or more a year. And this is keeping leverage at a manageable rate. What's the biggest risk with REITs? Debt. You buy real estate with debt. Nobody buys real estate with cash, right? You want to use other people's money, deduct the interest expenses, and arbitrage. So that's 13% a year plus dividend growth. 56% compound annual growth rate in balance sheet loans outstanding, a 6.6% increase over the last 6 years. It's a newer company, so it's kind of on a faster growth trajectory. Debt well in hand. As a rule of thumb, I want debt to be less than 50% before I start worrying about my REIT. Now, this is an interesting factor. When I was first giving this presentation over the last 18 months, we were generally in a rising interest rate environment. And we saw in December what happened when Powell, I've got that right? So when you get to be my age, you've got so many Fed chairmen, you can't always be sure who the current one is, chairpersons. So right now we have Powell, and it looks like in December that they're going to keep tightening. So the market just collapses, just dies, right? And then not long after, was it January, I think, is, well, you know, I'm not so sure the pressure. Then boomerang, right? This portfolio does 13.7% in January. And I got to tell you, not a fixed income, dividend income portfolio does not do 13.7% in a month. But it reacted very strongly in the short term to the change in interest rate expectations. What Ladder does is they have floating rate loans with interest rate floors. So you get the ability with floating rates to raise the rates as prevailing rates are rising. But there's a floor for when perhaps rates reverse. So you get some downside protection with upside in a rising rate environment. Second type we talked about REITs is the closed-end fund. These used to be very well known in the 30s and 40s before the invention of the open-end fund, which is the mutual fund we used to be more familiar with, where you can only buy and sell at the end of the day when the net asset value is calculated from all the closing prices of the stocks owned by the fund, stocks and bonds owned by the fund. The closed-end fund is a mutual fund that operates as a stock. There's a limited number of shares. If you want to raise more money, yeah, you can borrow it, but you can also issue more shares. A mutual fund has as many units as there are people who there is money, people who want to buy and want to own units. There's no limitation. Uses debt to increase returns. It's all about the manager, as it is with mutual funds. But unlike mutual funds, where Bogle exposed the emperor with no clothes, that the actively managed funds do not outperform stock market indexes over periods of time, you've got some really good closed-end bond fund managers. How many of you have heard of Jeffrey Gundlach, the bond king? This is a guy that does not have to work for a living, okay? There was a great interview with him recently where he actually talks about the town where I live, Marfa, Texas, and some lessons about that, which I got a minute there. We'll get to that. Gundlach has two closed-end funds. One of them always sells at a premium to net asset value, which I'm about to review, and one of them always at a discount. He does not need to work, but he loves doing this. And he runs, actually, the one selling at a discount to net asset value, wonderful, wonderful closed-end bond fund, and we get the benefit of his expertise. The joy of that is that these people have been doing it in rising interest rate environments, falling interest rate environments, good in the US, bad in Singapore, a long time. So it's all about the manager. Now, I don't mind paying management fees to someone who's good. I don't like paying management fees to somebody who's mediocre. And all these yields I'm quoting to you are net of the management fee. This is what we get. They tend to be too small for institutions, good for us. If you get Barron's, it's a rare time when they discuss an illiquid stock or a closed-end fund. They have to throw us a bone now and then, but their readership is too vast. As they say in the value investing world, this is an idea for your personal account only. When it's, I don't know, its daily volume is 10,000 shares or something like Sears Hometown and Outlet Centers. Now that was Sears Outlet Centers, not Sears the bankrupt company. Right? That's a whole other issue. I have to defend myself. So we have floating rate bond funds, closed-end funds. An example would be the BlackRock Floating Rate Income Fund, which I mentioned at the very beginning, yields 5.2%, which if you think, actually that's a couple months ago. If you think rates are rising, 5.2 is a good place to start. Discount NAV is 5%, and the NAV is increasing. Now, what do I mean by that? NAV is simply net asset value, assets minus debt. It's just like your net worth. Everybody's familiar with their net worth. Unless we have so much we don't have to care about it. And I'm not in that situation yet. So closed-end funds are generally valued on, okay, am I getting a good deal? Am I being able to buy it below net asset value? That's simply, in the bond case, the value of the bonds it owns minus the debt used to finance those bonds. And that divided by number of shares is net asset value. And as any good value investor knows, sometimes stuff is on sale. And we can buy $1 of bonds net of debt for 95 cents. In this case, case of BlackRock, FRA, it's selling for 95 cents on the dollar. Now, closed-end funds routinely sell for less than NAV. But if you track a fund's history of selling at a premium or discount to NAV, you can determine whether it's a short-term window, you can buy, get a discount, and then later see that window close and you get some capital appreciation. All this stuff is available on any of the online sites we use for free charting, free information. Now, okay, back, forward. So let's illustrate this. We haven't had any fun for a while. We had the rubber duck, we're now going to the window. Think of the top of the window frame as net asset value. That is the value of the bonds the fund owns minus debt divided by number of shares. But the window's open, the current price is less than that. Case of BlackRock floating rate, 5% less. That difference between the net asset value and the current price, there's always this magnet pulling it up. Now, of course, you have to look at the fund and determine its history. Does it always sell at a 25% discount? Well, then you're always hoping for a day that never comes. You're like Alice and the Red Queen in Alice in Wonderland, where the Red Queen says, jam yesterday, jam tomorrow, but never jam today. If you have a closed-end fund that is selling for a large discount to net asset value, and it always does, you never get the jam from the window closing. And I mean jam in a jar, not like door jam. All right, so here we have BlackRock Floating Rate Income Fund. The window widens. This is last year, period in May. Your NAV stays steady, but the price drop is a buying opportunity. The more your gap, the more the window is down, the more downside protection you have and the potential for upside capital appreciation, which is great because you're buying this for income. You get a few points of capital appreciation and it's just like it's giddy, we're dancing in the streets. Okay, our next dividend bucket, go anywhere bond funds. We don't just want US floating rate bond funds, we want to have some diversification here. So we're looking at global. We can play in all sorts of low inflation bond markets. For example, Australia. Surprisingly, Indonesia has been a good bond market. We want managers who know where to go to do this. I cannot be an expert on different bond markets, nor do I really have any interest in doing that. I can pay somebody a point to do it for me who's been doing it for a long time and is very good. So AllianceBernstein Global High Income, 7.2 currently, 12.5% discount to NAV. That is a high discount historically. So we can be sure, now, we have enough downside protection so that our potential upside is very low cost. Morgan Stanley Emerging Markets Bond Fund, 11.8% discount. Now you'll notice both of these are 12.5% and 11.8% discount. And these are high discounts to NAV. Why? Because people generally think of the international bond market as being somewhat more volatile, and they are right. So the market determines that we will get a bigger discount for that volatility. Let's look at infrastructure plays. These are infrastructure closed-end funds, interestingly, and bond funds, and REITs that invest in toll roads, pipelines, utility transmission lines, all sorts of things that are not guaranteed to be here forever, but look pretty good for that security. Cohen and Sears Infrastructure Trust owns utilities, pipelines, toll roads, airports, railroads, ports, telecommunications companies, and more. By the way, remember Li Keqiang from Hong Kong? One of his companies owns the Panama Canal on both sides. You pay when you go in, you pay when you leave. Talk about, I mean the Arctic Passage, yes, I think that's very cool, but I do think the Panama Canal will continue collecting for a while. I'm just going out there on a limb. 7% discount to NAV, 8.7%, and here's an interesting thing. Just to go back to the point about getting a raise on our initial investment, if we go back to 2013 and we see the dividend raises, dividend hikes, we see that after only 1, 2, 3, 4, 5 years, we're getting 9.3% on our initial investment. So we keep getting a little bit hike, some inflation protection, some raise. It'd be nice to get a raise in retirement. Recession-proof REITs. And here I gave a sneak peek, showed a little leg on this for Medical Properties Trust, which owns medical office buildings and hospitals and rents them out. And an interesting thing about Medical Properties Trust, the guy that founded this observed an anomaly, which is that hospitals can't get financing. I mean, it's really, really hard. It was at the time. Banks did not want to lend to build a hospital or buy hospitals. It was too insecure an income stream, too speculative a venture. I don't quite understand that, especially since, well, there was an excess of hospital beds at one point, but I don't think we're seeing that now. Probably some of you are more familiar with this than I am. In any event, he determined that he could buy hospitals and rent them or lend to hospital owners. Medical Properties Trust. 5% dividend growth a year on average. Current yield 7.3%. So you're looking at an effective return of 12.3% annually. And this is kind of what it's done. Obviously, with price, you're always going to get volatility, but what you want is your income to be steady and rising. So here we have the orange line is the price trend, and the blue line is the dividend trend, and tons of volatility, but over time, the price and dividend hikes are raises trend is correlated, both of those items. You get dividend up, price up. Secure boring bonds. Wow, I think we're going to have our 10:30 break a little early. So secure boring bonds, here I'm talking about municipals. And if we're talking about your rollover 401k and an IRA, you don't care about municipals. But most people also have, I mean, if I may venture, most of us in this room probably have investable assets and taxable accounts. And that's where a municipal bond fund can be helpful because you get a higher effective yield from the non-taxability, right, of the income. And the reason I picked the Nuveen AMT-free municipal credit opportunities fund, say that quickly, is that you're free of the AMT. So you're getting all this income, let's say, in the municipal bond, and it's all lovely and tax. You get a tax benefit from it and so on. But in the case of this, it's also free from the alternative minimum tax, which affects more and more of us at certain income levels. And your discount to NAV is 6.8%. The tax effective yield, depending on your tax bracket, your marginal tax rate is 9%, roughly, in the 30% range. And I haven't even mentioned the increases in NAV too much, is that Even bond funds, you'll see some price appreciation, some not so much perhaps, or the yield appreciation because over time they're trying to increase the value of their portfolio. And not just through debt, but perhaps issuing shares at opportune times.
Quick question.
Sir?
Isn't the income from this also exempt from the Medicare tax, the Obamacare tax?
Not my area.
I'm pretty sure it is.
Okay, so the question was, is it also from FICA, right? Or the surtax, the
3.8%.
right.
ACA tax, I believe the income stream
Right.
is exempt from that too. So your after tax turns even higher because of that.
A huge benefit.
Yeah.
Right. So and that was about 3.8%, was that the hike? Right.
Tax reform didn't change that.
The tax reform didn't change that. Yeah, it just blew a hole in the deficit. Whoa, no politics. Okay. I was trying to control myself. Okay, but that's actually not political, right? That's just, it's, right. It's just real. Sir, question. Why is it that closed-end funds normally, but not always, sell below NAV? I think it's, well, why would you, this is my theory, which is why would you pay $1 for $1 of assets unless you think, the manager is so great that the returns will be fantastic. Think of it this way, GARP investing, growth at a reasonable price, the theory that you invest at a multiple, whether it's free cash flow or price to earnings, below what the growth rate is, and you're essentially saying that the company will reward you with returns in excess over the growth rate. So it seems to me that a discount is saying, okay, I need to have a little bird in hand of potential upside, so I'm not going to pay too much for assets. I'm not going to pay $1. Or for the Gunlock fund, the other fund, other than one I own for clients, where it's basically a 12% premium to NAV. So they're betting that Gunlock is so good that paying up with the excess, you'll get rewarded. But I think for most closed-end funds, they're not well understood. And there's just like, okay, I want a little downside protection. That's the best I can do. What I try to do is look at the history of the discount to NAV, not the just objective discount to NAV. So all the ones I'm talking about here, even the ones that are just 5%, they typically do not sell for these discounts. But you have to look because, sometimes it's cheap for a reason, right? So you need a long-term manager who has a record of increasing NAV and functioning in all kinds of interest rate environments. Best I can do on that question. Sir? With Gunlock, was that the question? Isn't that a mystery? He said, well, Gunlock has two funds. They're both double line in his company, and one sells for a discount and one sells for a premium. I have no answer to that. Just that the one that sells for a discount, the discount typically isn't there long. Sir?
Do you have a maximum for leveraging on these closed-end funds? Do you have a maximum number?
The question is, do I have, like with REITs, where I want to see no more than 50% leverage, do I have a maximum on closed-end funds? I do not. It's like I know it when I see it, but I don't, I honestly, I want it to be less than 50%, like, 20 or 30, something like that. The problem with, it's like buying, it's like you're buying bonds on margin. And everybody buys real estate on margin, right? But the bond market can be pretty crazy. And so I want managers that use some, but not too much. That's the best I can do on that.
There are closed-end funds that have no leverage.
Yes.
So I'm just saying, so is that a better thing than, because I've read where 32% is the average leverage amount, and I try to keep under that.
Yes, I mean, it's just, you don't want to be, I use the margin example again. You don't want it to be 2008 and you're getting margin calls. Now, we wouldn't, but our manager would. right? I would say, you know, if it's below 30, I feel pretty comfortable, but it depends on the manager. And the gentleman said that he's read that the average is about 32%, and I think that's a pretty good number. I just wouldn't be comfortable with much more than that, you know. I'm conservative, but I'm not crazy, right? If you can, a little leverage by somebody who's been doing it for 20 years, something like that, I feel pretty good about. Okay. Just to give you an example of the volatility of this method, we would expect that something like the 50-50 blend of stocks and bonds, the REITs and the closed-end funds that I've discussed, would be less volatile than the S&P 500. A year is nothing. I'm not using this as like, oh boy, you know, no, it's just to make a couple of points. I would expect, okay, the red is S&P 500. The green is this particular thing as I sort of fiddle around and try to not do too much damage. So here you have what you'd expect. In March of last year, the less bad, actually up, than the S&P. Here, less up than the S&P. You'd expect it to be less volatile on the up and down side. And then an odd month where it was more than the S&P, and another odd month, and a normal month where it's less than the S&P, an odd month where it's more. Here, less up, it's down. That looks more normal. October, which was a bad month, less down, which you'd expect, and an anomaly, better than the S&P. Less down than the S&P in December, you'd expect that. And then this insane January, where it just zoomed 13.7%. And that February, you'd expect less than the S&P. But there, I just think it was short-term, major short-term emotion in response to the Fed's whipsaw change of policy between December and January. Yes?
Your y-axis there, is that the change to the NAV?
No, this is stock price. I mean, no, excuse me. No. This is total return of the method for that month. That is good, good. Yeah, I neglected to say that. It's like, what are we looking at? Right.
Maybe your axis, young man.
Yeah, right. Well, reminds me of my math teacher. Right? Yeah, right. This is total return monthly, okay, of the portfolio. I mean, for a dividend income portfolio, I mean, this is like 2 years worth of returns, right? It's just nuts. But at apogees or perigees or extremes, you get this kind of whipsaw. So you will have volatility, but over time, and one of the things that I usually do a whole series of slides on rising interest rate environments, but we don't have that right now. And one of the things is to show that the REITs and the bond funds perform well in rising interest rate environments, even though you would be sort of surprised about that. And part of it is REITs, typical rental contracts for commercial real estate include inflation escalators. So you're getting rising rents. Sir?
Since 2009 or so, we've been on an increasing economy. It's been positive net. You can't just look between now and then and say, oh, we're doing better. And actually, you've only shown 1 year, so that's not...
Oh, no, this is just for a very small thing. This is not to say I'm so great, do this.
Right. So do you have more data than that?
I've only been doing this particular portfolio for 3 years.
3 years. You have
Right.
3-year data?
Yeah. Oh, it's my benchmark is 3 years plus inflation plus 3%, and it's well in advance of that. Okay. But you have to accept volatility. But if you accept the volatility, you don't care because your dividends are flat and rising. And this is the hardest thing I have to get clients to understand, is that if you're picking a dividend income strategy, it's the rising income you want. Now, over time, we hope, right? I mean, because we can't guarantee we'll get some magnet pulling the stock price or the closed-end bond price. But you cannot It's the income you're after. So you have to accept this volatility, right?
So one more question.
Yeah.
You've got 6 elements in your 2 types of portfolio, right? Bonds.
Right, bonds and closed-end bond funds and REITs.
Stock, which is really just REIT.
Right.
Are all of those dividend-generating elements? Every one of your,
Yes,
investments are
yes.
dividend-generating?
Yes.
So what's the total dividend income per year then?
6, 7, 8%.
It is.
I'm talking about based on the purchase
So
price.
that's what you then live on, is what your argument is.
Yes, and you don't withdraw. I mean, look, obviously, depending on who you are, you might be withdrawing. But my suggestion here is that it kind of doesn't take a whole lot of brains, because that's good in my case, that you have that you can earn more and withdraw nothing or less. I mean, we say no withdrawal, but it depends on your situation. But if you're withdrawing 4%, you are withdrawing principal. Right?
So how do you
Sorry.
allocate your assets within the 2 different categories?
50-50.
That's for stocks and bonds, but within the stock category,
About a third and a third and a third for each of them. Yeah, but I'm not religious on this. I don't rebalance. If a particular one is doing better, I leave it alone, right? I'm not an asset allocator, but they do tend to sort of balance over time. So you've got to get the clients focused on the dollar income level from the dividends over time. And I can show them, year 1, year 2, year 3. But Tom, the price is all over and I'm worried. And I just, got to get them to understand. You don't care about the price unless you're withdrawing. You care about the income. And I had a guy in Cleveland, the Cleveland AAII. Yeah, 1 second, sir, we'll get to you next. And he put it that way to me. He said, don't focus on the price, focus on the income. And I thought, why am I not saying that? Why am I taking 10 minutes to explain things when I should just make it simple? Sir?
Are you avoiding REITs that invest in brick and mortar retail?
Okay, so Justice Scalia was asked at the departed Justice Scalia was asked at a law school symposium, Justice Scalia, you and Justice Thomas vote together a lot, and you're both originalists. Do you have similar viewpoints? And Scalia said, I kid you not, I'm an originalist, but I'm not crazy. Justice Thomas is kind of extreme, regardless of your viewpoint. So that was my answer to your question, which was what? Oh yeah, I'm not crazy. I like REITs, but I'm not crazy. Yeah, brick and mortar retailers. I mean, anything that can be eaten by Amazon, I'm just scared of. That's not to say that, do any of you remember the strip mall explosion? Was it the 80s? No, strip mall, not strip, When everybody, I remember when I was graduating from law school, there were a couple of firms in Boston, and they did like strip mall real estate development legal work. And I thought, oh yeah, it's exploding, Well, how many strip malls do you go by today that are just empty, and hurting? So yeah, I concentrate on urban commercial office buildings, medical. In the case of mortgages, not ladder capital because it mixes it. Pure mortgage REITs make me nervous. And infrastructure, Yeah, boy, God, Amazon's going to run the world. But we'll get to that in the second part. Oh, it's after 10:30. Got a break. And then this is, of course I have to do this. This is the total return, not just month by month. This will never happen again. I guarantee you, I will never produce these returns for clients in the rest of my life. But it just shows you that even a strategy like this can have a lot of volatility in the shorter term. So this isn't like to show, oh yeah, right, Tom should manage all the money in the world. That's not the point, because that would be wrong of anyone to do. But it's to show that this can have volatility in the short term. It's not without volatility, but we need to focus on the income. Okay, I'm happy to answer questions during the break. How long is our break?
15 minutes and back here at about 10 till.
Thank you very much, you wonderful audience.